Last week was a busy one for retailers, and many apologies that we were caught on the hop when Associated British Foods released its trading update a few days earlier than expected. And the coming few days will also put the retail sector firmly back in the spotlight. This is partly down to some macroeconomic data that's due on Friday, the 20th of September, in the form of the latest GfK UK Consumer Sentiment Survey and also the UK retail sales figures. A steady uptick in the GfK survey has flattened out a little bit, even as wage growth has continued to outpace inflation, at least on average, and interest rates have started to come down. Perhaps the effect of higher borrowing costs is finally catching up with consumers, along with a still modest increase in unemployment and questions over what the budget may bring on the 30th of October when it comes to taxes and the new government's efforts to get the numbers to add up, let alone to try and balance the books. Investors can also look forward to passing another clutch of corporate updates, and they'll include first half results from Kingfisher on Tuesday the 17th of September, Moonpig's trading update for the first 6 months of the fiscal year on Wednesday the 18th, first half figures from Next on the 18th, and a third quarter update from Ocado on Thursday the 19th. Now, as with last week's gaggle of retailers, these firms all have different target markets and different business models. Kingfisher is a leader in DIY in the UK, France, and Europe, with physical stores and an online presence. Moonpig is an online provider of gifts, experiences, and greetings cards. Next is an omni-channel retailer of clothes and homewares with a profitable financing arm for good measure. And Ocado doesn't really want to be an online provider of groceries at all. It's already sold half of that business to Marks and Spencer, and would much rather be an intellectual property specialist that licenses out its automation, technology, and logistics expertise to other retailers, in the view that that's a better path to long-term profitability and cash generation. Retailers is the 17th best performing sector out of 39 within the FTSE 350 over the past year, and that's with a gain of around 10%. Of the quartet due to report in the coming week, well, Next shares have done the best with a 41% advance over the past 12 months. That's compared to Kingfisher up 22, Moonpig up 21, and Ocado, well, their shares have more than halved. In fact, Next shares trade at an all-time high, buoyed by the latest in a succession of profit forecast upgrades from Chief Executive Lord Simon Wolfson. Stronger than expected full price sales in the first half, coupled with lower costs, prompted the company to upgrade full-year pre-tax profit estimates by £20 million or 2%, to 980 million. Full-year full-price sales are expected to grow by 3.4%, and any review of guidance for either that number or profit may determine the market's response to these interim figures. For the record, a year ago, Next recorded first-half total sales of £2.6 billion, pre-tax income of £420 million, and a dividend per share of 66p. Analysts are looking for a 9% increase in the full-year dividend for fiscal 2025, so bear that in mind when assessing this interim report. And also, the retailer continues to run a share buyback programme. Meanwhile, Kingfisher's first quarter update in May was, to be frank, nothing flash. Like-for-like sales fell 0.9% year-on-year, with the UK at 1.2% and France down a disappointing 5.3%, as Screwfix outperformed B&Q here in the UK. Analysts will look to those trends in the second quarter and first half overall, and check that Chief Executive Thierry Garnier is sticking to his profit guidance for the full year. Back in May, Mr. Garnier retained his adjusted pre-tax profit forecast for the 12 months to January of between £490 and £550 million. That's down from £568 million last time, and he's also targeting free cash flow of between £350 and £410 million. Now, that cash flow is going on new store openings, investment in IT and e-commerce, as well as cost efficiency programs, and after that, it's funding cash returns to investors. A flat interim dividend of 3.8 pence a share is expected by analysts, while the FTSE 100 member is also running another £300 million share buyback scheme. The trading statements from Moonpig and Ocado are unlikely to be as comprehensive as those full first half statements, and they will release detailed figures of their own for the first half and full year on the 31st of October and next February, respectively. For the year to April 2025, Moonpig has steered investors to expect mid to high single-digit percentage growth in sales, although the medium-term goal is more than that, and it's to generate double-digit percentage increases in annual sales and a mid-teens percentage increase in annual earnings per share. Watch for growth at Moonpig, Greets, Red Letter Days and Buy a Gift, trends in subscription growth and repeat customers, and above all, orders and average volumes. The Ocado statement, well, that's going to focus on the retail 50/50 venture. At the first half stage, active customers rose 8% year on year to just over 1 million. Average orders per week rose 9% to 428,000, and average basket size grew just under 2% to £123, helped by average price rises of just around 1.5%. Second quarter sales overall rose 12% year on year in a further acceleration. However, the whole company did remain loss-making. Expectations of a pre-tax profit for the whole business, including the IP, well, they've been pushed back out to at least 2027, and much there will depend on the technology licensing arm, where there's been a setback in Canada with Sobeys, but ongoing progress in Japan with Aeon, Australia with Coles, and in the US with Kroger. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.